Hello again. I'm very excited to continue with you the financial component of the business plan. Actually, it's our second session. We still have two more sessions. So, as for the other than this one, as for the session, you are talking about the financial needs, how we estimate the financial needs of our startup, the price framework, and the strategies that we can use in order to price our product or service, the LTV CAC ratio, which is the customer lifetime value to customer acquisition ratio. Let's do this. In order to avoid any insufficiency in terms of capital, it's very important to avoid the question actually in a very scientific way through researching and planning. So to make it possible, the startup expenses is the leading worksheet that will help us determine the financial needs. Before heading to the calculation, we need to understand some terminology. The expenses, first of all, are it's the word expenses actually. It's about expecting or estimating the expenses of our startup. What will it cost you to get your business up and running? So every kind of cost and every kind of expenses, direct, indirect, actually is part of this expenses. The key to accuracy here is attention to details, because sometimes some kind of expenses might be hidden and not obvious to the eye. So it's very important to research and to understand the operation business to be able to estimate accurately the expenses and not find out later on that the expenses are not accurate. I don't mean when you are 1% margin in 1% margin error, but if you are talking about hundreds of dollars, maybe it would be feasible. But if you are making a mistake in terms of hundreds of dollars, I don't think that it will be always possible to cover it. So it's very important from the beginning to expect accurately the expenses. So we also mention that it includes the tangible assets, the equipment, inventory, the services, remodeling, insurances. What else we have to expect, what we need to buy in terms of goods and services, the vendor, to comparing shops. So all of these are part of the expenses. It's not only about the price or the cost itself, it's also about the terms of payment, the delivery, the reliability. The service itself is very important because, for example, in terms of cash flow, if it costs X, it's not the same in terms of cash flow. So we might be paying X divided by 8 each month, or we can be paying like X divided by 2 each 6 months. It's a different approach, obviously. Second, it's the contingencies. It's about adding the contingencies. For sure, to explain it also in terms of narrative. It's not only about the number because you are estimating it, but it's about the philosophy behind it. So, yes, also the working capital. Third, it's the working capital. Actually, it's obvious you can't open the business with zero amount or zero balance in the bank account. You need a certain cash cushion in order to make the business rest on it, in order to meet expenses while the business is getting on. It's about the 12 months cash flow, as we already mentioned. I don't think we have something else to mention. Then I think it's the fourth word now, the sources. Now that you had already estimated the capital, we need to know from where the sources are. Each amount is paid by whom, and how much we're gonna be injecting in terms of partnership, investors, etc. Collateral, it's the fifth, if I'm not mistaken, and the last. You'll be using this plan to support actually the bank loan request. Use the section near the bottom, as you can see in the module, to secure the loan, to give your estimation of the value of this item. The collateral are the reserves that you are using in order to take in parallel a certain amount of money, a certain credit. So it's about being prepared of having some proof that estimates the value of the collateral. Now it's time to go to the calculation. Let's go. First of all, it's about the sources of capital, the owner's investment, the names, and the percentage of ownership related to the amount they invested in the company. Then that's how we end up having the total investment. Then it's the section related to the bank. So it's the bank loans, the name of the banks, the amount borrowed from each bank. We will have, while adding those numbers, the total bank loans. Also, we might have like a different type of loans. We will understand that when we will be talking about how we finance our startup. It's our last session. So for the time being, it's about understanding that we need to mention all these type of loans in details. So we will end up having one number, which is the total loans. Okay, let's continue. After precising actually all type of loans or type of ownership investment, we have to specify the startup expenses. When we say so, it's about the building and real estate, the purchase, the construction, the remodeling, any kind of action related to the real estate or the building itself, or the factory, etc. It depends on your own startup. The total buildings real estate. Then it's about the leasehold improvements. You will end up with a total leasehold improvements. Also, you add the capital equipment list, the furniture, the equipment, fixtures, machineries, anything. And we also always have others, because you might have something specific to your own industry, to your own company, that might not be present in another company. We also add the location and administration expenses, such as the utilities, the rental, the legal and accounting fees, the prepaid insurance, the pre-opening salaries, etc. We add the opening inventory and the categories and the amount, the value of the inventory that you are starting with. The advertising and promotional expenses that might include any type of advertising, printing, travel, entertainment, etc. Also, any other kind of expenses that might be specific to your industry, specific to your way of doing things. So we will end by having the total. The working capital will be the sum of those. You will be able to just add your number if you find the Excel sheet already posted. So to summarize this section, you can also see in the module, I will have a look with you. You will have the sources of capital, like in 3 words, in 3 lines, with the total of funds, and then the startup expenses minimized. If you don't need the details, you might go and check this section for some decision making, for some I don't know, for if you need a certain number. You won't always have to go and check all the details of the sheet. You can go to the summary, but it's important to make the detail and then to make the summary out of it. So I believe that's it. Yeah, I believe that's it for this estimation of capital, for this estimation. And now let's talk about something new and different. Let's do it. The pricing framework. How we decide to price our product or a service. It might be like simple if we think about it, and maybe easy also, but in fact it is not, because if we price the product higher than the competition, we'll face a problem if it's not with a certain strategy. If it's less, so much less than the competition, we might skip certain profit. So it's not that easy. It's not only about pricing the product higher than it costs us to produce or to manufacture. It's like a little bit more complicated to make such decisions. It's not actually only about the profit. It is about the profit, but it's not only about the number, it's also about the business culture, the relation we want to maintain with the customers, the value we are presenting to the customers. As you remember, we invested a lot of our time to detail, to understand, to discuss the value we are proposing to the client or the consumer or the user. Also about the competition, etc. So we have a bunch of stuff to take into consideration before making the decision that would end up. So a lot of research, a lot of papers, a lot of study. It might at the end up with one number, but it's not the one number like that fall down from the sky. No, it's the result of all this calculation. So all of this calculation and all of these strategies, methods, and logic that we want to go through. Let's start so we'll understand better what it's about. What are the objectives that hide behind the price framework, the pricing strategy? First of all, we need to take a look on the return on investment. If the company is expecting a certain return on investment, this return has to be reflected in the pricing. So there is an example that you can find in the model. It's very basic. If you are investing $100,000 and you want a profit of 10%, so you need to understand that the profit that need to be taken into consideration in terms of dollars is a $10,000. This $10,000 is the revenue from the sales of a certain number of units. So that's first. Second, many companies search to maximize their profits. So it's about making a larger revenue, cutting costs, boosting customers' loyalty. So all of these are part of the objectives that a company might be searching for while pricing, actually. We don't have to forget to highlight the importance of keeping the value of the experience and the image of the business and the position of the business in the market. We can't forget the competition. You can't forget the value itself, if it's really valuable in terms of this X amount, etc. So that's why we said it's not a separate activity that we are doing, it's a whole strategy. Third, some companies search to increase and maximize their market shares. Some companies might go for a lower price in order to gain more market shares. It depends on the objective of the company. Fourth and last, some companies search to equal the competition. So it's about a status quo strategy. It's used, for example, with airlines. As you can see, when an airline rises or lowers its prices, directly the competition follow and do the same. So it's very important to understand what is the objective behind the pricing strategy. Let's continue to know what are actually those pricing strategies. We know a lot of methods and processes that are used in order to price certain product or service. We can mention like the price scheming, the market penetration pricing, the premium pricing, economy, bundle pricing, value-based pricing, dynamic, version-based, psychological, and sandwich pricing. We can take our time to discuss each and every methodology. We will choose like some of them that will benefit most a startup, and you need to go and check the module for the 1,000th time I'm saying that in order to find more details about each type of pricing methodology. The price scheming. Actually, it's a way used when we are introducing a really innovative product or service to the market. So when we don't have a lot of competition, or if we can say we don't have competition, I don't really agree on this term, but sometimes it's used. So let's say if you are introducing something relatively really new to the company, to the market, I mean, we can use the price scheming. The price scheming is about introducing the product or service at a high price and then lowering the price when we find that the competition is increasing. So it's about raising capital from early adopters. It's very known in technology that in high tech industry there's some people, there's a segmentation, a certain segment actually in the market that they are first adopters, as it is in the name, first adopters. They are the first to adopt a new technology. For example, you can be the first from this segment if you directly go and buy the first from the first week, for example, the iPhone, for example, the Apple product, the iPhone, the newest iPhone. And you could be a person that buys it after 2 to 3 years, only when you need a new phone. So you are not an early adopter. You can be from a segment that goes and try new technology just from the first period of time that they are introduced to the market, in terms of laptops, in terms of it could be also any type of activities, not only in the technology world, but it's commonly known in the technology world. So it's about pricing it higher till when we find at a high price, actually it's not higher, till the time when the competition is increasing, so we go and lower the price. So that's how we will be cutting, actually not only raising capital from early adopters, we will be also cutting the road for a future and more competition. When they will see that the price is lower, they will be like less competitive or less capable to compete, so they will think twice in terms of competing with your own product. So you will cut the road for for more competition. The second type of pricing that we'll be discussing is the market penetration pricing. It's the opposite of the price scheming. It's about taking over the competition by lowering the introduction price. After developing loyalty, customers' loyalty, more market shares, the business will increase its prices. It needs also to be done with another type of strategies, such as the potential losses. If you are not capable to handle and to inject capitals through the process, will be stopping the business. So we'll be able to understand that till a certain point, the business won't be capable to break even. They won't be capable to meet their expenses. So we'll need to inject capitals all over the process till the point where we develop a good market, a good customers pool, I mean. A good customers pools, it means like loyal and strong customers base. Okay. It's combined with financial plan. It's combined also with marketing strategies in order to be able to attract those needed base. The last methods that we're gonna be discussing together, and as I already mentioned, you can find like a lot more of methods in the module, but for the presentation, for this class actually, we'll be discussing this third one, and that will be the last one that we are talking about together. The premium pricing. It concerns actually a business that is creating a very high quality product or service, and they are targeting a certain niche of customers, the wealthy customers, that they are having the ability to pay, and they are willing to pay a significant amount of money in return of this high quality product. The strategy is about delivering the product and finding the accurate niche segmentation. It might fail if we don't have an accurate branding strategy, a value that is desired from this niche segment, and an accurate communication channels and messages that are delivered to the right customers, the right niche that we are searching to sell. So it's about offering the value that is needed and wanted from a particular segmentation, a particular niche, a wealthy customer, having the ability and willing to pay for this product or service, being able to communicate the high quality of our product or and service to this particular customer, reaching out to this particular customer, communicating the right message to this particular customer, developing the right branding strategy from the smallest details. Maybe it is the logo that you are using on our packaging, till the most complicated feature that you are offering through the product and service. So the premium prices is a strategy like a lot of other strategies that needs to go with the other techniques from different departments together in order to be able to execute, actually, to make sales. Okay. Our last section for the session is the relationship actually between the lifetime value of customer and the cost of acquiring that customer. So the ratio is the customer lifetime value LTV to customer acquisition CAC ratio. It measures, as you already said, the relation between how much you are paying in order to acquire this customer, and in return to how much this customer is active toward buying our own service or product. So it's an indicator of client profitability and sales and marketing effectiveness and efficiency. We can judge through this number if you are applying our resources adequately, if you are spending enough or a lot of money, more budget than needed to acquire certain customers through marketing, etc. So the numbers are meaningful. We will take some examples to understand, after calculating it, how we interpret the numbers. Actually, that's what matters. For the terminology, we already mentioned it several times. The LTV is the lifetime value of customer. We will have the time to calculate it and to understand how to find this number. The CAC, the customer acquisition cost. We will also take the time to understand how to find the cost. And the ratio is the LTV over the CAC. If the LTV CAC is 1 to 1, it might appear that the company is efficient, but actually it is not. Just before understanding it, what it is 1 to 1, it means the cost to acquire a customer is the same as the customer lifetime value. So if we are spending $1 to acquire a customer, he's spending in parallel $1. It might feel that it's efficient, but actually it is not, because it will make the company lose money in reality, because this number only take into consideration the marketing expenses, and it will not take into consideration the shipping costs and the taxes. So eventually the companies we're gonna be paying more more than what we will be making out of a customer if our LTV equal our CAC. Another example, if the LTV is lower than the CAC, if the ratio for a company is 1 to 1.25, it means that the brand is spending more to acquire a customer that it will ever make from that customer, even when only marketing costs are taken into account. So bringing other costs into consideration, it's likely losing a significant amount of money per acquisition. It's a bad strategy, and some actions have to be taken. When the LTV is higher than CAC, for example 2 to 1 or 4 to 1, if a brand has an LTV ratio of 2 to 1 or 3 to 1, it can expect to make 2 or 3 times what it spent to acquire a customer. The perfect ratio is the 3 to 1. It's a common benchmark for good ratio, not perfect. Actually, it's a good ratio. This is also a common number that venture capitalists and other investors want to want to see. So if your investors see that you are your LTV over CAC is 3 to 1 actually, it means it's a good ratio and you have a good image towards the investors. The investors will be attracted to invest money into your company. Your marketing strategies are efficient. It might be like the accurate number. It's not like not one form suits everyone. It's sure that it might be like relative to your industry. You need maybe sometimes to check the number for your own, the good number or the good benchmark for your own industry. But in general, it's like around these numbers. A higher ratio, as we started to mention, the 4 to 1 is an indicator for growth opportunity. It means you can consider increasing your marketing spend. You can think about increasing what you are paying to make a marketing branding, so you will be able to gain more customer shares and more income from those customers. When it's higher than 5 to 1, it means you are leaving a lot of growth behind or on the table. This is a great opportunity to scale up advertising and marketing efforts. All these numbers are an example to understand what does the ratio mean. Now, what does the ratio mean? Now, it's time to understand how we do this calculation. Let's do that now. As we already know, it's a ratio. So the LTV, as we write it, 2.CAC is the LTV over the CAC. It's the LTV, the lifetime, divided by the cost of acquisition. The LTV, it's the customer value times the average customer lifespan. What is the customer value? It's the average purchase value times the average purchase frequency. What is the average customer lifetime? It's the average of numbers of years during which the customer purchased from the company. So when we calculate the customer value, which is the average purchase value times the average purchase frequency, and we calculate the average customer lifespan, we multiply those two numbers together, we will find the LTV, the lifespan actually of a customer. The lifetime value of the customer. At this stage, we have the LTV. We calculated the LTV. It's time to understand and to calculate the CAC. It's the cost of sales plus the cost of marketing altogether divided by the new customer acquired. So when we mention the cost of sales and cost of marketing, it's the ad spend, the advertising budget, the employee salaries, the content creation. When we say content creation, it's everything related to the content. If you are acquiring some talents, the benefits you are paying, the production cost, everything related. Also, it includes the technical cost, the technical support, the applications, etc. The inventory upkeep, it's if we are talking about SaaS company, I mean, all the technicalities and the inventories in question, maintaining and optimizing the tangible product or the cost related to that, the cost related to updating the user experience satisfaction, if we are talking about an online experience. So everything related to the cost of sales and the cost of marketing are added together, divided by the new customer acquired, and the number of new customer acquired. You will end up with a number which is the CAC. At this stage, we divide the LTV with the CAC. We will end with the ratio 2 to 1, 3 to, etc. All these examples, and we analyze. We go forward from the ratio and we analyze the meaning of this ratio to understand the situation of our company, to judge the efficiency and effectiveness of our marketing strategy while comparing them to how we are attracting and how much we are attracting loyal customers, and how much we are spending toward how much we are getting from what we are spending. That's it for today. Just have a look for the conclusion and a fast review.